have that data as well. Mihir, you spoke about you focusing on domestic themes versus the global themes right now. We are talking about banking index contributing big time to the moves that we are seeing. From here, what? What sectors do you think will work? Will banking continue to outperform?
Because in terms of absolute levels, while the banking index is at highs, but if you look at the price to book of the index, the valuations of the index, we are still not above the pre-pandemic levels. So there is some valuation buffer there in the banking space. I'm talking more specifically about banks. I think NBFCs probably may underperform a bit because of the liability, getting cheap, more dear interest rates going up as far as borrowings are concerned. But banking for sure should continue to do well. And if you look at many of the construction-linked cap good infra segment stocks, valuations there are far below pre-COVID levels. So I think a lot of the themes in the domestic space still have valuation buffers.
Okay, well, Ajay, I just want to, extend that point forward with regards to the banking space, because there are two real stories which are emerging. The PSU banking space is, within its own orbit at this point in time, Ajay, and the valuations on a price to book, on a price to book basis on a 1 year forward, many of them are not even at one time. But do you think that this is the time to probably invest in PSU banks?
Well, the answer is simple, that where do you see the...
Okay, I think we've lost Ajay, but Mihir, I'm going to throw that question to you. PSU banks, would you buy them at current levels?
Sure, as a tactical play, yes, but not as a long-term structural play. Tactical because the private sector banks have outperformed quite a lot. There is a valuation gap that has opened up, so there's always a scope for that buffer to kind of narrow. But I think if you were to look at a buy and hold strategy, it will still be in the favor of the private sector banks.
Okay, private sector bank. Ajay, are you with us? Are you? Okay, I think we lost Ajay. We'll try and reconnect with him. Mihir, actually, Ajay, the last time he was on, he made an interesting point. He said, you should now, fixed income is going to give you a serious run for your money, versus equities. Your thoughts? Peculiar time to ask this question, Mihir, with the equity index at all-time high, but any thoughts?
No, definitely. The bond yields versus earning yields is definitely in favor of bonds at this point in time. And that could be the only domestic risk factor to the inflows into the SIPs and the other financial equities investments that we are seeing. Because, he's right, bond yields, when you have private sector, some of the newer private sector banks giving you 6 to 7% on your savings bank account. And of course, CDs are going at even much higher levels. 1 year CD for a lot of the private sector banks are trading at very attractive 8-9% levels. So to that extent, there will be a competition from fixed income to the equities market. Not only that, but I think at some point in time, even the real estate market, residential real estate, will begin to look like a value play because not much money has flowed there yet. So you might see some competition from other asset classes if equities continue to do so well.
Okay. Mihir, I just want to take that point forward with regards to the entire macro environment, because that is going to, at some point in time, aid the sentiment. Do you think that inflation is probably peaked, and then when the RBI does meet next week, there's a possibility that they would be more benign in terms of future rate hikes, and that's probably also being factored in somewhere into the markets? Not to mention that we have the FOMC also, where there could be a possibility that they would be slowing down. So is that a key factor that even you're probably telling your clients at this point that we're working in a better, probably a slower trajectory of rate hikes now?
Sure. In any case, I think the situation in India was not as bad as the rest of the world, because in India we are used to 6-7% inflation. It's not like we've not seen that before. But for the Western world, 6, 8, 10% inflation is something that they haven't seen in generations. So it's a much bigger problem for them compared to us. I think the RBI's key consideration, apart from inflation, of course, that's important, would also be the currency stability, because we have seen a drawdown in the FX reserves in the last few months, and that has continued except for the last week. So to that extent, I think currency stability and macro stability, how global flows are emerging, will also be a consideration for the RBI. As far as India is concerned, I think the RBI's trajectory that they have projected of 5 to 6% inflation and going down to 5 and thereafter going down below that in the next 3 to 4 quarters should hold true. I think so. I don't think we are in a panic as far as inflation is concerned. But I think RBI will also be driven by the global developments.
Okay, so.
Sorry, go on.
We have Ajay Srivastava who's back with us. And Ajay, I would like to take this point forward as well. When inflation is not a worry for the markets and we are seeing them at record highs right now, maybe factoring that in as well. But what about valuations? Do you think at these levels, we are way beyond the normal mean? We are, but do you think this is the time when some profit should be taken off the table?
You already answered the question. You already answered it before you started the saying that, yeah, of course, valuations are astronomical of the Indian market.